I think that's a good transition, Jay. I want to read a quote. You sent me over last night a quote from Seth Klarman from the infamous, famous, I don't know what you want to call it. I want you to give a little history because you know more about it than I do. His book, Margin of Safety, I think came out in 1982. And I'll just read it real quick. Investors are sometimes their own worst enemies. When prices are generally rising, for example, greed leads to investors to speculate, to make substantial high-risk bets based upon optimistic predictions, and to focus on return while ignoring risk. At the other end of the emotional spectrum, when prices are generally falling, fear of loss causes investors to focus solely on the possibility of continued price declines to the exclusion of investment fundamentals. Regardless of the market environment, many investors seek a formula for success. The unfortunate reality is that investment success cannot be captured in a mathematical equation or a computer program. Why'd you send that over, Jay? What's your takeaway?
So I came across this book a couple years ago. I was on X and I was listening. I think Bill Ackman was doing his like books for the year that he was recommending people do, and he kind of gave a summary of it. And it was, I think, at the start of 2024. I think it was like the books of the year, and he did it at the beginning of 2024. And obviously, we had just come out of 2023. We weren't doing any deals at the time. We were kind of looking at, okay, what's our next step kind of going into 2024. And I had heard about this and I was like, okay, like I realized he's kind of on the institutional and he's on like the equities side, but I just feel like it kind of always in the back of my head of like, hey, I want to read that book at some point. And finally I was sitting at kids sporting events last night and I finally like, okay, I pulled it up and I was reading through it and I read that, and you and I had just had a conversation about like, how do we make sense of these deals? Like we're banging our head against a wall. Like, do we stretch? Do we be conservative? And I just was struck by that quote of almost like exactly what I want to say. It's like, how many times have you said, like when we pull up the model of like, show me the return that you want, I can make our model hit it.
Yeah.
And it's like we saw the
not in a good way,
yeah.
But as in you can manipulate the numbers to say anything.
And like back in 2021, 2022, when we saw the mania, think of how prevalent equity was. Like we had people calling us all the time, like, can we place money?
Well, the numbers, if you just rely on the numbers made a ton of sense in 2021 because the debt was low, the cap rate interest rate spread was wide, and rent growth forecasts were very high.
Yeah. And so there was kind of this mania. Well, now all of a sudden everything's kind of come back down to earth. And you and I have been talking about it for probably the last 2 years. Like the reality of this like idea of the basis buy and like what is the relative cost of replacement versus like the economic value, and at what point is that reconciled? And there's probably 3 deals you and I have been like, we should pile a bunch of money into this deal. It makes sense. But I put it on paper and not a single investor would be excited about it.
Yeah.
And I would finally last night I broke down. I'm just like, I'm trying to understand, okay, like as we go through here, like reconciling what we know about the numbers, what we know about our market. But then it's like, okay, what is kind of a risk adjustment? And like, how do I think about risk? And it was like I said that you and I have had these conversations and you kind of know my thoughts about some of the financial engineering that was happening previously, and he kind of in the intro gave the story about trading sardines and cans of sardines, and it was like everyone's trading all these cans of sardines, and one guy's like finally tries to take his like profits off the table. He's like, I got all these sardines, let me eat a can of the sardines. He opens up and they're completely rotten and rancid, and then someone turns to him, he's like, you're not supposed to eat the sardines, you're supposed to trade the sardines.
Yeah.
And I feel like that for a period of time, like that's kind of what was happening in our industry. Like you said, cap rates were so low, our interest rates were so low, cap rates still had a nice spread, and so like everything made sense on paper, and so you could make a lot of sense. Banks were giving you money, and so you could make that trade, and it's like, hey, I can make money off of this. And if you set it up with the right debt and you had the right operations, you were fine. If you didn't, now all of a sudden you're eating one of those rotten cans of sardines.
Well, then when you actually have to go and like sell the sardines by the sardine, and they have to be like edible.
Yeah.
It all of a sudden starts to matter, and that's when I think you start shifting from pure speculation to actual investing or operations. And the analogy in the multifamily world that makes sense to me is, that the period of when, you could buy something and you could have a value add plan, but cap rates were just compressing. Someone could execute poorly and then you could sell it in 2 or 3 years and still make a lot of money, regardless of whether you added or extracted value from the community, whether residents were having a horrible experience, whether your employees were having a horrible experience. It didn't matter. It's because someone else was willing to pay more for that can of sardines or an apartment. Now we're living in a world where the sardines have to be decent quality, and people are starting to say, "I don't want the old sardines," because there's a lot of like new cans that are out here that were just like a shipment of
Brand
new
new,
cans
fresh caught.
just hit the shelves, and they're going for a discount. And I'm not going to buy your old crappy, stinky sardines. And so the advantages for operators, it matters all of a sudden, to being able to execute a value add plan and actually achieve that pro forma rent, that rent premium, or to provide a living experience for residents of where they're willing to pay more rent, where your operations actually have to work and you actually have to be a good operator to make money, to make an investment work, and actually to get cash flow, not just leave some meat on the bone and tell a value add story for the next buyer to pay an artificially low cap rate to just cycle out of the next one.
Yeah, and that, I would say, for a good 10 years, that was the story.
Yeah. So how do we shift? How do we shift, and how do you look at deals now, more from, I guess, that value perspective, and also from a pure, like, how are we going to operate this to make money?
I think it's difficult. I mean, obviously, like, we try a lot of different ways. We obviously look at anything that's marketed. We have good relationship with owners, so we try to see if we can get some stuff off on market. But it's like when a broker brings a property out, they bring out like the purchase price and the cap rate of the purchase price. But the reality is that there are costs associated beyond just the purchase price. So obviously we have to look at kind of our all-in yield, and we have to figure out what the actual like return on the total money we're investing is. But even the brokers at the broker dinners last week that were here, they were like, well, everyone's looking at in place. Yeah, everyone's looking at in place. Everyone got sold that story of the value add for 10 years. It's bitten probably everyone that's in the market. And people just aren't excited to try to bite that off again. And I think it's, as we are looking and buying in the market, we're buyers playing chicken with other buyers of like, who's going to pay that little bit more? Because I mean, I'd say there's probably 3 deals we're looking at right now. I know many of the other owners that are looking at it. I would say,
hey, stay off our deals, guys.
I know the range that they're looking at. I may not know the exact number, but I tend to know how they underwrite, and I know how they've come in on other deals, and they're probably coming in pretty close to where we are.
Yeah.
And none of us are coming in at probably the seller expectation price.
Yeah. Is this healthy? Do you think it's reintroducing some discipline into the industry?
I think it's healthy. It makes it difficult. You and I were having,
but should it be easy?
It shouldn't be easy. But I do think that you and I had this conversation this morning, kind of on a different one. But in an efficient market, like, things should be priced kind of appropriately. And I struggle with multifamily because multifamily is this thing that it's not efficient. Like, we have really good brokers, we have great relationships with those people, and we have very intelligent people. But just the intricacies of the deals, like, it's hard to be like, hey, this is exactly worth this, it's exactly worth this. But as you pointed out, when you have time to make these transactions and when they're illiquid, you can't make an emotional decision to sell something because it doesn't feel like it's going well. You have to be disciplined. You have to like go through a process. And when you have to go through that process, time forces you to make a little bit better decisions.
You can't, it's harder to panic sell, or it's very difficult to panic sell a multifamily property. Can you do it? Sure. But there's a little bit more restraint because there is a process. But there's less inventory though. So it can be kind of priced to perfection in some ways because everyone's kind of has the same data and everyone's kind of solving for the similar return, 50% IRR, 2x over 5 years.
Yeah, and so that's kind of where it is when, as that process is slow, it kind of funnels it down to where there really is kind of an exact price. Like, are there people that have bought stuff for prices that I wouldn't pay? Yes, but can I tell them that they overpaid for it? Probably not.
Yeah.
And that's where I think we're kind of getting to as a market, and it's just where are you comfortable with your operations in getting to those numbers.
And so I guess, where do we find the value? Where is that value trade? And if it can't be based on pure, organic growth, there's not a ton of growth. How much can you rely on, like the basis buy and cost of construction or cost of replacement? Because a lot of deals today, you see them advertised as a discount to peak pricing, or a discount to replacement, or discount to comps, and that can be a meaningful like metric of like, okay, well, sure, it's less than it was or less than other things were, but those things could have been overpriced, and it's
Shouldn't have been built. It's
it should have been built, should have been
costs.
bought, but it's irrespective of the actual return. And like, yeah, you can buy it for less than it was built, but if it has a zero return, it's still zero return.
Yeah.
So how do we make sense of that? Because you could still say, looking at something at an amazing location, and it's like it's a fraction of the price as it was 10 years ago. Is that not enough to go and buy it?
It's hard. And if you had asked me this a year ago, I'd have a lot different thought than what maybe I do now. A year ago, I'd have been like, I really want to buy that. I may not be able to put something on paper that can get people excited about it, but I really want to buy it. And if we don't have the investors, then obviously we can't. But like in the back of my head, I'd be like, well, how do I make that work? I think today, based off of what we've seen with kind of the pricing uncertainty with those deliveries that we talked about earlier, it's just so much harder to say, oh yeah, I would buy that, or no, I wouldn't buy that, because you just don't feel comfortable because of that lag. Like, we kind of thought there would be a cliff. Well, there's not really a cliff. So before, I would have said that is, they are mismanaging that for certain. Their rents are below market for certain. Like, I can do XYZ and get you there. I'm probably right, but I thought maybe I could have done it in 12 to 18 months, when the reality is, because of where the market is today, maybe it's 3 to 5 years. And that's not really a investment our investors are looking for.
Yeah.